Hi, welcome to Challenge DP. My name is Jacek, and today I'm going to show you how to create a telecom financial model in Excel.
Before I start going through a detailed monthly calculation, let's very quickly look at the structure of the model. So the way I structure this financial model is by dividing it into the section where you see the drivers, the main drivers of revenues, and then direct costs. Then you have some other central costs, some calculations of taxes, Capex, so the build cost, adjustments for things like working capital, taxes, and then eventually the calculations of cash flow. And then the cash flow is calculated, is shown before debt financing and then after debt financing. So the model assumes there will be some possibility of injecting a debt into the cash flows. So just starting from the top, this is a telecom model. So we'll assume here that we're building a network. For example, let's say you are a cable company or maybe a phone company, mobile company that builds a network that wants to address a certain number of properties. That's where you're going to see this line here with the number of properties passed. Then we'll assume that of those properties that is your addressable market, you will connect a percentage of them. So this is where you'll see the number of properties connected and the customer service uptake. So this is the number, the percentage of all those past properties that took your service. Then we'll have a revenue calculation. So the revenues are divided into a non-recurring revenues, which in our case will be your sign-up fees. So anything that you will charge your customers upon signing up for your service. And then you will have a recurring fees. So those will be your monthly charges. So the monthly fees that you charge to your customers. What I did here, I introduced here in the model different services that you may offer. Again, you can turn them on and off depending on the business model. But for example, in here you see that you have a broad offering where your network offers the internet or broadband, then the landline, which is just the standard phone services, also some mobile offering, and TV, cable, and then any other services. So those will be your main streams of revenues. Then I have some direct cost calculations. So those will be the costs that are directly related to providing the services to your customers. And again, they will use the same categories as we use for recurring revenues. So again, broadband, landline, mobile, and TV, and then other revenues. There will be some calculations for the customer acquisition cost. So anything that you have to spend for example, marketing for acquiring the customers, which will be directly related, which this calculation will be directly related to the number of customers that you bring online. And then also you will have some other fees, for example, like payment processing fees, bad debt, and others. So those would be variable fees that are driven by the revenues. Again, I will get to those calculations in detail in a few minutes. And then in addition to that, you will also have some what I call here network Opex. So anything, any costs that are related directly to servicing, to maintaining your network, and then any other direct OPEX fees. So that's what allows you to calculate your direct OPEX, and with the revenues, here we will calculate your gross margin. And then, as I mentioned, we also have some central cost. So for example, the first calculation here will be your staff cost. So how much money you have to spend to hire your central employees. So for example, your management, and in this case, any employees that are related to operations. Then there will be some general Opex calculations such as office, IT expenses, and other. This will allow you to calculate your EBITDA. Then you have some tax calculations, and then your Capex, so capital expenditures. So anything, any cost that's related to building your core network, but also any expenses, any money that you have to spend on connecting your customers, equipment, and so on and so forth. So this is the section that will deal with that. Then there will be some working capital adjustment, which eventually will allow you to calculate that cash flow before debt financing that I mentioned at the beginning. So this line will allow you to this line will be used to calculate approximately how much money you need in order to fund your business plan or your model, and then there will be some debt calculations. So again, as I mentioned, the model will allow you to inject some debt. So you will have some new debt coming in on a yearly basis at the beginning of the plan, and then you will have, and that will be followed with some debt repayments, and then related to that, there will be some interest expenses, debt fees, and so on and so forth, which then will allow you to calculate the cash flows post debt financing, and that figure, this line will then give you an approximate amount of additional capital that you need to invest in the model. So for example, this can be used to calculate the level of equity that you have to insert into the model. Okay, in terms of the structure of the spreadsheet, you will see that I also included here to the right the main assumptions, which will be linked to that cash flow model sheet, which we'll get to in a few moments. Then there were some metrics to the right. There will be also some sensitivity testing, stress testing of the model, what-if scenarios, which we'll get to at the end of that tutorial. And then below here, I've also included, while here you have a cash flow model summary, you also here have profit and loss statements, a proper cash flow statement separated with cash flow for operations, investment, debt financing, some balance sheet calculations, and then finally the calculations of the return on your investment. Okay, so that's those sections we'll get to later towards the end of this tutorial, after we've gone through our cash flow model sheet, which is the calculation of just monthly calculations that are needed to complete our financial model. Let's get into those monthly calculations. So you'll see that similar to what I showed on the summary page, the structure or the order of the calculations will be very similar to what you've seen before. Plus, there will be some additional there could be some additional lines, additional calculations that will allow you to easily follow the forecast that I create here. First of all, you will see that I listed all the main drivers here at the top of the spreadsheet. So you have your month number, then you also have the date, and then I also listed the year and the month for each of this date. Then I've divided the model into a few phases. So you see there was those flags, which is 0 or 1, which tells you whether you're in the build phase of the model, a growth phase of the model, or maturity phase. In our case, the build phase is basically the period during which you are building your network. Then you have a growth phase being the period in which you increasing your customer reach. So this is a more aggressive growth where you're accelerating your reach. You're gaining quite a lot of customers. That would be assumed to be at the beginning of your service. And then you have a maturity phase, which is just a phase where you're slowing down with your customer growth. You basically achieve your target, and then you just try to maintain that market reach. You will see that here in the columns A and B, I've listed the assumptions that I use for each of the calculation. So what's important to notice here is if you click off any of those cells, you'll see that they're linked to that summary page. For example, here you have that link to a summary Q8, which would be the line the cell over here. So the idea is that you actually use that summary page, that table with assumptions here. So any cells are highlighted in that sandy yellow to change the assumptions. And then I just repeat those assumptions here to the left, so you don't have to go back and forth between the sheets. You can see exactly what assumption is being applied. But if you do want to change the assumption, you should go back to the summary page and then change the assumptions here. And then you will see the change in assumption will be reflected in the column, in one of those cells in the column A or B. Okay, so as I mentioned before, the model starts with the main drivers, and we're going to start with, first of all, estimating the speed at which you're going to build your network. We've assumed here that it will take 30 months to build the entire network. So you will see that assumption here, which is called core network build progress. Those numbers will be then that will influence your capital expenses, so your build costs, which will be calculated later. But you'll see that you can see the progress of the core network build in here, and then you will see another line called network connection build progress, which is just the number of connections, or your progress in terms of the connections that you're making towards the target that you want to achieve. Okay, so you'll see later on here, for example, what we want to do, we want to get to, we want to connect 35% of our properties. We're assuming that you will not be connecting any properties for the first 6 months. So you will start making your first connection 6 months after you start building the network, just to allow for the network to sort of start up. And then from month 7, you'll see that that connection progress, which is basically the percentage of the target of that, whatever the target you set for your number of properties connected, how much of that target has been achieved so far. Okay, and then those calculations are linked to, first of all, to the number of properties passed. So the number of property passed, you can think of that label as your addressable market. So this is how many properties your network is passing nearby, right? So how many of them are able to access your network? And you'll see that we have here a new properties passed, which if we just go to that calculation here, is just basically just the difference. So the incremental increase in the percentage of the build progress times the number of your target properties passed. Okay, and then you have here your total properties passed, which is just the sum of accumulation of all the numbers from the current and previous month. Then in addition to that, you also will see that here you will start calculating the number of new connections. So that's driven by that number, that progress, connection build progress, which is in here. It's also a function of your target market reach, and then also it takes in consideration churn, okay? Because we want to make sure that if you lose any of the properties due to churn, or any of the customers due to churn, that's also going to be taken in consideration when you calculate your market reach. Okay, the churn in our case is simply just the number of properties that number of customers that will leave. You will see that I start my churn calculations 12 months after the first property has been connected. You can change that assumption, but basically the model allows you to set the minimum term from your contract. So that assumes that if you, for example, sign your customers for 12 months contract, they won't be able to leave until a year after they sign up, right? So that's why you will see that delay. And it's simply the way the churn works. It just uses that calculation where you look at the numbers of customers that join the service, and then you see, okay, well, of those number of customers, what's the percentage of them that will leave? Okay, so that's the calculations that you will see in here. And that allows you then to finally calculate the number of properties that are connected at the end of the month. And then if you look at that market reach calculation here, you will see that Yeah, so the target in our assumption target is 35%, and then eventually the model reaches the target in the month 42. So we're assuming that it takes 36 months to for that growth to be achieved, and 36 months plus 6 months of the setup period. So in the month 42, you should get to 20.9 thousand of the properties, which is the 35% that you will see in here. Okay, and again, that 35% is the percentage of that 60,000. Then we also have some calculations here for the service uptake percentage breakdown. So that basically assumes that, okay, well, of all your customers that you have, so for example, here of all those properties that you've connected, what's the uptake for your different level for different kind of services that you offer. So for example, you can assume that for my broadband and internet, 80% of my customers will take this service. Let's say a percentage of people will take the landline. You will see that the model also assumes to increase this uptake or decrease the uptake of certain services over time. Then, for example, your mobile uptake and, for example, your TV or cable offering or any other services that you offer through your business. And then you will see that that calculation then allows you to calculate the number of users again by service. Okay, so it's just a matter of multiplying the number of connections that you have, and then you just multiply it by that service uptake in order to see the number of users by service. Okay, and then that also allows you to then calculate the number of new users by a given service offering, which then leads us to calculations of revenues. Okay, so the way the revenue is calculated, once you have those drivers already listed here above, so the number of connections and then also the number of users that take up different services that you offer, you can then quite easily calculate revenues and then direct cost. Okay, so first of all, again, as you'll see, what I do in the model here, I try to list all the main drivers that are applicable to a given month, to a given period. So here, for example, I have my one-off connection fee to calculate my non-recurring revenues, and then I also have my monthly service fees below here for each of the service offered. You will notice that the prices here, as we scroll to the right of the model, the prices will increase on an annual basis. That's because I assume there will be some inflationary adjustments for the pricing. And you see here I have this service price index calculation in here, which basically allows you to increase the price by 3% on an annual basis. Okay, therefore you will notice the increase. Okay, and now knowing, for example, what is my one-off connection fee, I can calculate my non-recurring revenues that related to sign-up fees, which is simply just that fee times number of new connections. Yeah, so you'll see that it's good to spend a bit of a time to set up all those drivers here, so then it's just easy to connect them with your other assumptions, in our case pricing. Okay, and similarly, if I want to calculate the monthly recurring revenues, for example, in order to calculate the revenues that I will get from my broadband offering, I would just calculate my monthly pricing or my monthly service fee for broadband, right? All of them obviously are averages, and then I will calculate that number, multiply that number by number of users that use my broadband, right? So that's why it was important for me to list those different users by the service that they take. Okay, so I do exactly the same thing for the other line. So for example, for landline, mobile, and so on and so forth, and that allows me then to calculate or forecast my non-recurring revenues and recurring revenues, which I'll then bring those numbers together to give you my total revenues, and then that allows me, for example, to calculate my average revenue per property. Similarly, I will now calculate the direct cost. So in our case here, direct cost would be related to providing the service to your customers, okay, and also maintaining the network and the acquiring your customers, okay. The idea is that they are driven directly by the uptake in your customers or your network build. So for example, here, again, I'm assuming that I will have a cost which is expressed in either on the basis on a per unit or per connection basis or as a percentage. So when you see the percentage, that's simply just the percentage of the revenues that you generate from your services. And when you see the dollars figure here, this will be charged on a per property or per customer basis. Okay, and then you will see that I also have the cost per acquisition assumption here, and the payment processing fee. Again, cost per acquisition will be driven on a per unit basis. The payment process fee will be a percentage fee. Again, you will notice that, for example, that number here or the numbers above increase by 2% at the beginning of the next year. That's because I also assume here there will be some increase in cost, which will be adjusted on the annual basis. Okay. And then if you just follow that calculation here, for example, so let's take the service provision cost for broadband. As you recall, we assuming here that we'll charge $2. So every user that we have using the broadband cost on average $2. So you just take that number here and then multiply it by number of users that use that service. Okay. Similar calculation will be done for the landline. So you have a $4, which are multiplied by the number of users using landlines. And then in the case of, for example, mobile provisions or TV provisions, you have a percentage of revenues, right? So you take the revenues that you generate from mobile and you just take 70% of that. Same thing with the TV. And the reason why this may happen in sort of practical ways that you may actually some of the services, for example, as TV, you may just pay like a content sharing fees to the third-party providers, right? So you may not necessarily provide the TV services yourself, but you may have a third party and you just have a revenue share with them. Okay, that's the idea behind using the those different methods of calculating those costs. But again, you can modify it, or you can use the other methods, or whichever suits your business plan, business model best. Okay, so that allows you to calculate the service provision cost. Then you also have the network maintenance costs, and those costs would be driven by would be driven as a percentage, would be calculated as a percentage of your of how much money you spend to build your total network. So something that we will touch on in a few minutes. So, and then it's basically you just say that, okay, well, you have to allocate whatever you spend on your network, take a percentage of that, let's say divided in our case by 12 because you want to do it on a monthly basis. And that's the estimate of how much money you have to spend on maintaining that network. And then you also have other customer costs, which is here just driven by the your number of properties that are connected. Okay, so there will be some other other cost related to your connections. Again, this is a bit of a placeholder or contingency, so you can modify it. You could also change the basis of the calculation. So you see that in here we calculate everything based on the number of connected properties, but you may have some also costs that are related just to number, on average, the numbers of properties passed, regardless. So the size of your network, regardless of how many customers or how many properties you will actually connect to your network. And finally, I also have some acquisition costs, which will be quite important part of this model. So for example, in our case here, we're assuming that every customer that you will bring incur a certain acquisition cost. So that's how you will calculate the marketing here. So for example, in here we'll see that we are assuming in our model that the acquisition cost on average to acquire a customer, it will cost you $100. So you just take that $100 number and then you multiply it by the number of your new connections. Okay, so we know that in every new connections that I bring in online, it will cost me X number or X dollars, or it can be also euros or pounds. You can change the currency to whatever market your model is addressing. So that's the calculation here. And then you also have some payment processing or bad debt on other fees. So again, those were the percentages. This is driven on a percentage basis. So you just take your revenues and then you multiply those revenues by that percentage and then allocate that estimate to this cost. So in this way, we have our service provision cost. So those because directly they are related directly to providing services to your customers. Then there will be some network OPEX, so any costs related to maintaining your network, your infrastructure, and then you will have some here other direct costs, which would be your marketing acquisition costs, for example, and payment processing. And that allows you then to calculate your gross margin in here, which then leads us to calculation of central costs. So for the central cost calculation, we'll first calculate the staff cost. So any costs that are related to your salaries, to hiring the employees. And then you will see that, first of all, I want to calculate the number of employees that you have in your central office. So that could be your management. And then the number of employees that would be related to operations. Okay, so the difference between the two is that you will see that your headcount for the central office is pretty much static, so that's more predictable, whereas the operations it varies. Okay, so you see that actually it's growing, and that number varies depending on the number of connections that you will have in your network. So number of your customers. So you will see that as I'm increasing the number of customers, I'm also increasing the number of employees that I've assigned to operations. And the way it works in this model is that I'm assuming when you see that number 500 here as an assumption, it just basically assumes that for every 500 new customers that you have online, you need to hire another person. Okay, so obviously you can change that number, you can increase it or decrease it to adjust to whatever is appropriate for your business plan. Now you will see also below that I assume some average salaries. So you see that here I have an average salary on an annual basis, which then I convert it to a monthly figure. And again, you will see that that number also increases in line with inflation. So there will be an increase over time. So that allows me then to calculate my central office staff costs simply by taking the number of employees in my central office, multiplying by that average monthly salaries, and then also the operations. For operations, I'll do exactly the same thing, which will give you my total staff cost. Okay, one thing to bear in mind that in this model, I assume that that average salary here actually is fully loaded. So that also includes any costs that are related to you. So any, for example, taxes or any contributions that you have to pay as an employer. Now, you can change that calculation. So you could, for example, add, if you wanted to separate it to, you could add another line here where you just show the average salary that's paid to employee. And then you could have another assumption somewhere below where you also have the expenses, employee expenses. Now below here, you see that I have some other calculations. For example, I need to calculate the office expenditures, so how much money I'm going to spend on the office. You'll see that in this case, I assume that that's also driven by the number of employees. So I'm just assuming, okay, well, take your total employees number and then multiply by some average figure. Then I just put some placeholder, for example, like IT expenses, some monthly general expenditures, and then other contingency. contingency here is just driven as the percentage of your recurring revenues. But that allows you to then calculate that general OPEX, then the staff cost, and then eventually with that, so we have a gross margin. If I take the gross margin, subtract from this gross margin my staff cost, and then the general OPEX, that allows me to calculate my EBITDA, which is the earnings before interest, tax, depreciation, and amortization. Okay, then you also have some calculations of tax, and then the model goes into the bill cost calculations. So the way capital expenditures of built cost model works here in our telecom model is by assuming that those costs will be driven by the number of past properties and also by number of connected properties. Okay, so remember that past properties in our model is assumed to be number of properties that are accessible to the network, right? So those are the effectively addressable market, and then the connected properties are the properties of the customers that you actually connected to your network, the customers that take your services. So you'll see that as always, I've listed all the assumptions here. So your bill cost assumption, service connection, and the equipment assumption in terms of the average cost. And then eventually that allows us to calculate the passive Capex. So any Capex that's related to building that core network, and then any cost that are related to connecting the properties, which will be what we call an active Capex in here. And the way those costs are calculated, so the first cost is just calculated by the number of employees that you need to hire during construction. Those will be the management costs, so that you will see that they will go away after the construction is finished. So those, for example, can be related to costs related to the project management. And then you have your core network bill cost, which is simply that figure here, so that 550 multiplied by the number of new properties passed, right? So this is going back to the beginning of the model. So multiplying those two numbers allows you to calculate the that core network build figure, okay, which together gives you the your passive Capex or passive build cost. And then you will see that we have calculations of the network connections. So this is the that figure here. So for example, we're assuming that it will cost on average $175 to connect a property to that core network. And you see, so in order to estimate that figure or forecast this figure, I need to take that 175 and then multiply it by the number of new connections. Okay, so here again, the driver will be the number of connected homes. Then I also, this number of new customers will also drive my equipment cost. Okay, so I separated the two. So you will see that I'm also having an assumption for how much money on average I need to spend for new equipment. So you will see that, okay, well, I'm taking that figure $100 here, and I'm also multiplying it by the number of new connections. Okay, and then finally, here, just to complete that active Capex calculations, I also do assume that you have a bit of a calculations here, which allows you to replace the equipment after, in our case, 60 months. Okay, so I'm just assuming that, okay, there will be a time after a certain period where you need to upgrade or need to replace the equipment in here. Okay, and that allows you to calculate that active Capex, right? Which in turn gives you an estimate of the total Capex of your total bill cost, which is just the sum of the two. Then finally, I'm making adjustments for working capital, which is just the adjustment for your payable movement and receivable movement, and this allows me to calculate my cash flow for a given month. So this is again the cash flow before debt financing, and that here allows me to accumulate this cash flow. So this will give me an approximate of money that I can say, okay, well, how much cash deficit or later on hopefully surplus I have in my bank account. which is an approximate of money that you will need. So that minimum here is the amount of money that you will need to in order to fund your business plan. Okay, and then finally, we have also here line with new debt, debt repayment, interest expenses, and debt fees. And you'll see that those calculations are connected to the lines below. So if I scroll down here, you see that I have a debt model. So I'm assuming that I can finance some of my core network Capex with debt, okay? And that's where that figure here, that leverage comes in place. For example, here, I made an assumption that given that I set the model so I can draw a debt 3 times, so in the first 3 years, every 12 months. Again, those assumptions are linked to the summary page table. You will see that here I'm starting my debt schedule, starting with the opening debt balance, which in month 1 would be a 0. And then I'm adding a new debt, which is a 9.2 million. That 9.2 million is simply the 60% of my forecast annual core network Capex spend. Okay, so I'm assuming that from the model I can see that, okay, well, in the next 12 months, I'm going to spend $15.4 million dollars in our case on the building the core network. Of that amount, I'm assuming that I can finance that for debt at 60% of that figure I can finance for debt. Therefore, I can add 9.2.4 million of debt to my debt balance. Okay, I'm also making some assumptions in the models that for the first 36 months, for example, in this case, I don't need to make any principal repayments. So you will see that in that period of first 3 years, I'm just adding the only debt to my debt balance. Yeah, so you see, for example, in the year 2, January 24, I'm taking the 60% of my forecast core network spend, which in our case, the forecast bill cost would be 15.7 million, so 9.4 million, just above 9.4 million is 60% of that figure. So I'm adding that debt in here, okay? And then eventually, starting from month 37, so after 3 years, I'm going to start repaying that debt in here, okay? So that's the calculations that you can see on this line. Now, even though I'm not making any debt repayment or principal repayment, I still have to pay some interest. So that's where the calculation of interest come in here. So you'll see that I'm taking my debt opening balance and anything that I add to my balance as the basis of the calculation, and I just multiply it by my annualized interest rate, which is in our case here set to 8%. Again, you can change that in your assumptions and then divide by 12. You divide by 12 because the model is done on the monthly basis. This is an interest rate, which is quoted on the annual basis. So you just convert it to a monthly figure. Okay, that gives you your interest paid. And I'm also assuming that you need to pay some loan arrangement fees. So those are one-off fees related to drawing a new debt, which is simply, in our case, a percentage. So for example, 1.5% times the new debt figure. When the model gets slightly maybe more complex is in this line. So that's the expected payment calculation if you were not to have any principal repayment holidays. So this line basically calculates the full repayment, so principal plus interest, if you were to wanted to repay your debt balance over a certain period of time. Okay, so very quickly, this formula here uses the Excel's PMT calculations, PMT formula, which simply takes the few inputs here. So first of all, in order to calculate the payment that you have to make in order to repay the debt, you need to specify the rate. So again, you would just take the 8% divided by 12. And then you need to take the NPER. NPER is just the number of periods that are left in order to repay the debt. So the model allows you to set the term of the debt. In our case, is 120 months. And for simplicity, I'm just saying that all this 120 months applies to the entire debt facility. So it starts counting from the first month of your debt model, which then allows you here to see, okay, well, if in January 23, I had 120 months left in my debt facility, then the next month there will be 119, 118, 117, and so on and so forth. So that simply allows you to set the number of repayments that you have left for your debt, which then fits into that NPER calculation, and then the PV figure then it's just your debt balance. So it's just your opening balance and the new debt. So for example, if at the beginning of the month my debt balance was 9.2 million, just above 9.2 million, my interest rate was set at 8%, and then I have 118 months left to repay this debt. I would have to make $113,000 of payment in order for me to repay that debt over that period of time. Where there was a slight complication is that we have also this principal repayment holiday. So we're only making an interest payment. So you will see that for a period of time, that payment figure will be increasing, and also increasing with the new debt coming in. But eventually, once we start making the repayments, you see that that figure becomes fixed, becomes static. So we know that, for example, in here, I know that, okay, well, my debt balance is $23 million. Okay, my interest rate is 8%. So if I go to my rate calculation here, divided by 12, the number of repayments is 84, and my debt balance is almost 23.5 million. So I need to make a total repayment of 365,000, or almost $366,000. Now we know that of that figure, 156,000 156,000 will go towards the interest repayment, which is again simply that 8% times the debt balance divided by 12. So the difference between output of that payment calculation and the interest repaid will go towards the principal repayment. And this is where you see that this debt, because again, we're not drawing any debt, is slowly going to be repaid over time. And the best way to check it is to see that we said that, okay, well, we'll repay the debt over 120 months, 10 years. So after 10 years, you should see that the debt goes to a zero. The debt balance goes to a zero. And then with that, I can now go back to my cash flow model, and you see that here I simply connect the output of my debt model in my new debt, the debt repayment figures, which will happen here later, and then the also interest expenses and debt fees. And this allows me to calculate my cash flow post debt financing. And then if I accumulate those figures, you will see that if I take the minimum figure, then I can calculate my deficit, which then will be my proxy to estimate how much equity or any outside capital I need to inject in order to fund the model. Okay, so going back to my summary page, you can see that I simply aggregated all of my monthly numbers into an annual view using here the SUMIFS formula. It's just taking your year as the criteria for the sum, and then using that year row over here. So that aggregates your revenue figures, your OPEX figures, and also your Capex in here to eventually calculate the cash flow before and post debt financing. And then in addition to that, I've also listed here profit and loss summary. Okay, so you see that here I have a proper profit and loss statement. In terms of the revenues and gross margin, EBITDA lines, you'll see they're very similar to, or pretty much identical to the summary above. But then I also added some calculations for depreciation and amortization, which are linked to the cash flow model in here. So you'll see that here I have a bit more estimates, a bit more calculations for related to your Capex expenditures with different assumptions for the lifetime of different assets. And that all those adjustments here, also interest and debt fees, taxes, then allow you to calculate your net income in your profit and loss statement. Then I also have the cash flow statement. So this cash flow just allows you to separate the cash into cash flow from operations, investment, and also have the here cash flows from debt financing. Again, you'll see that I've added here some checks, which just ensure that the output of your cash flow here agrees with the cash flow model that we had above. Okay, they should be identical. It's just a different way of presenting this model in a more standard format. Then I also have the balance sheet in here, which is all of the statements are linked to each other. So that allows you to calculate your current and long-term assets, and also any liabilities, and the owner's equity, which some of the line items here will be linked to the table below. The most important thing is that you always want to make sure that your balance sheet checks. So basically, the number here, your total assets, equal to liabilities and owner's equity. And also make sure that those statements, so your P&L, cash flow statement, and balance sheet, they are linked to each other. Okay, so a change in one should be reflected in other, which is exactly where you see the links in here. And then lastly, last but not least, I also have the equity investment return analysis here. So this table allows you to estimate the level of equity that your business plan needs, and also the returns that you can expect from the plan, assuming certain valuation. Okay, so for example, in here you see that I'm just bringing up your EBITDA, cash flow for operations, investing, and debt financing, which allows you to calculate the cash flow before any equity investment, but post debt financing. Again, remember that we had those debt calculations before. This then tells you, okay, well, if I need, for example, 7.8, if my cash flow before equity is 7.8 million, let's say I need 7.9 million, just rounding up, of new equity. So that's the amount of money that you will get from your external investment, which is repeated in here. So those are your investments. And then the model assumes that, okay, well, at the end of year 10, let's see what the business would be worth if you were to sell it, or, for example, list it maybe on a stock exchange. Okay, so there will be some sort of exit event. The valuation method here is quite simple. So I'm assuming that you just take the EBITDA and then multiply it by a figure here. So for example, by 10. So this is the EBITDA multiplier that is used for valuation. That multiplier will differ depending on the market conditions and just generally the assumptions that you use. In our case, I just, for simplicity, I use 10. So that just simply takes the EBITDA that you had in your last year and then multiplies by, in our case, 10. Then I also make some adjustments for any cash that you may have in your on your cash, and any current assets and also liabilities. And then if you have any debt, then the model would assume that you also have to repay this debt. Okay, we've assumed in this model that you had a 10-year debt, so you paid off everything before that exit year here. But if you have a longer term, you would have a negative number here because you would need to assume that that's a liability which you have to take in consideration when you calculate the final proceeds. And eventually, that adding those numbers together, this allows you to calculate, okay, the amount of money that you investors would receive if you were to, for example, sell the company. Okay, and then with those numbers here, you see that I have my NPV and IRR calculations. So let's start from IRR, simply using the so those are your returns on investment. So the IRR formula here is quite simple. You just take that negative numbers first, which would be the amount of money invested, and then eventually that figure here, which would be the amount of money received by the investors. And then you also have the NPV calculations, which is similar. It takes the formula takes the similar inputs, but it also takes in consideration the a discount rate. Okay, so those are the figures here, and then you will see that those metrics will that feed into table here to the right. So you see your equity requirement, NPV, and IRR. And also, I've added some other metrics that allow you to, for example, see, okay, well, your level of revenues, EBITDA, on total level or per unit connected or passed. Now, as I mentioned, you also have all those table with assumptions in here, and the nice thing about that, keeping the assumptions here next to the summary page, you can actually see what happens to your overall cash flow numbers, but also, for example, to your returns if I were to change one of the assumptions. Okay, so you can run a sensitivity test on your model, stress test your model. For example, you can test, okay, what would happen if my market reach went from 35% to, for example, 25%. Okay, so we want to see, okay, whether I'm still generating positive returns, for instance, in my model. So let's do that. Change that to 25%. You see, okay, still making positive returns, but they have dropped from 24.8 to 17.3. Okay, maybe then let's see, okay, what happens if I do a 15%? Your returns drop to 2.7%. You see your NPV is actually negative because using a 10% discount rate. So that's the way to sort of stress test the model, and, for example, see what's the weak spot when it comes to market reach. Okay. Similarly, for example, let's go back to that original assumption of 35%. Let's see what happens to my returns if my debt leverage it's rather than being 60%. What will happen if I take it to a 40%? Okay, so there was a bit of a drop in your returns, but you see that, for example, your equity requirement went up, right, from when it was 60%, which is expected because now you need actually more equity because you can't finance as much cash requirement through debt, so you need to add more equity, right, which can be challenging using that model the other way around. Let's see what happens actually if I do 80%. So your returns are going up, and also your equity requirement drop even further. Okay, so that's one way of testing the model. And then you can, for example, also see, okay, well, what happens if my, for example, pricing assumptions are not correct? What if there's a downward pricing pressure? So rather than $35, let's see what happens if I can only charge $28 for my broadband. Yeah, your returns do go down, which is expected, right? So it's just a matter of stress testing the model and seeing how what is the level, what is sort of the lowest assumption I can use and still make this model feasible. Okay, and then you'll see that also to the right here, I've added some Excel's data tables. So what the Excel data table allows you to do, it actually allows you to use to do exactly this a similar thing to what we've just done, but in a more automated way. So you can, for example, insert your assumptions for debt leverage in the column, and let's say your debt interest rate in your row, and then see how a combination of two different assumptions, how, for example, in our case here, influences your equity requirement. Okay, so you see that here. This is actually the current assumption. So, for example, if I were to increase my interest rate to 12% from the current 8%, what will happen to my equity requirement? I need to insert more money because my debt servicing will increase. Okay, but then, for example, similarly, okay, what if I were to increase my interest rate, but then actually also increase the leverage, right? So the equity requirement will go down. So that allows you to do that. And then similarly, for example, if you want to stress test your assumptions around the build cost. So previously we looked at the cost per property passed when we're calculating the Capex. So you can see, okay, what will happen to my equity payback period, for instance, if I were to increase my cost per property. So that will increase because you just have to wait longer to get your money back. But then what will happen if I were to increase to the same payback, if I were to increase the market reach? You will see that the more customers, the higher the market reach is, the faster you receive your money back. Okay, so this is just an example of what you can do with the model. Once it's correctly set up, you have all the assumptions nicely listed in your table to the left, and then how you can use the data table to stress test that model and then find any weak spots. And finally, I've also added some calculations for the customer lifetime value. So here, using the model assumptions, you can see how the change in the assumptions influence the average annual value that a single customer would generate, but also how much money, for example, this customer will generate on during their customer lifetime. So remember, we use some assumptions around the churn. We're assuming that some of the customers will eventually leave your service, which allows us to calculate the overall customer lifetime. So you have your calculations of revenue here, then the direct Opex, eventually the gross margin, and then any allocations of the staff cost, central cost, and then eventually the cash flow generated by each customer. All of those figures I've summarized in here, so you can see. Okay, well, that's your initial investment per customer, which will take in consideration things like core network build, network connection, the equipment, and also the acquisition costs. So those will be any money that you sort of have to spend on the customer before they start generating the revenues. And then you have the revenues generated by the customer, any OPEX related to providing the services to the customers when they using your network, allocations of staff, general OPEX, some taxes, which eventually allows you to calculate that customer lifetime value. So if you deduct from that value the initial investment, this gives you the net figure. And for example, here we can see, okay, well, what's the return if you look on the money calculation. And then also here, I've added one more analysis, which is just the cohort analysis. So here's where we follow 100 customers, initial 100 customers for the lifetime. So we want to see how much money will those customers generate over 10 years, assuming that some of those customers will leave due to churn. So you start with 100 customers, initial 100 customers, you end up with 47. And then you can, again, using the assumption in the model, you can then calculate the cash flow from those cohort of 100 customers with the contribution here. So a contribution to the gross margin, EBITDA, and then the overall cash flow. Okay, and then here I've summarized that in a graph, which allows you to see the overall cumulative cash flow over the 10 years of the lifetime of those 100 initial users.
I hope you enjoyed this tutorial. If you have any questions or you'd like to download the template using this video, follow the link, which you will find in the description, or go to my website at www.challengejp.com. Thank you very much.